Hello, this is Melissa, the insurance exam queen, and we're doing a class today on state law and insurance regulations. Okay, so for this chapter, for this topic that we have, it really everything is state specific in a way, but this chapter either shows up as a really big percent, like in Washington, it could be up to 30%, or in like North Carolina, it's somewhere close to like 19-20%. In New York, it's only 9%. And in New Mexico, it's only 3%. So it really can, it can really be, a small or big. However, it is big or small, there are certain things that they test you on more than anything else. And having had experience of taking multiple state exams, I have a pretty good idea of the things that you are likely to see on the exam. In addition, I have taught all around the country, working at large insurers with all kinds of state exams. And I always have focused on these certain things. And the certain things that I teach are the things I want you to know and to memorize. And if you can know and memorize those things, you can secure a pretty good chunk of points from this chapter. Now, in the state regulations and insurance chapter, it's switching gears from all the other chapters. So whether you're doing life or health or property or casualty, they're going to be all about the policies and all about the coverages. This chapter is completely switching gears, and it's more about you as an insurance agent and the laws within the state for insurance. So the text itself, as you're going through this chapter, as you're reading this or watching the videos, it is a lot of information. It's a lot, and it's all legal stuff and laws and rules and fees and fines. This chapter really does love numbers. So the more numbers that you can memorize, the better. And like I said, I will highlight for you the numbers that you should know. And we'll even create a chart that if you were to take this chart and fill it in with your numbers, you would use it to study and memorize the most important things. Okay. So first, we're just going to start talking about insurance regulation as a whole, and then we will get into writing down the chart and the specific things that we want to know and memorize. So the first thing is knowing that insurance is a state-run thing. So it's not the president, it's not Congress, it's each individual state gets to run insurance in their state. There are rules coming from the police or from the president and Congress, the federal government, but most insurance is within the state, which is why, like with auto insurance, every state has their own minimum. So that's something, if you're taking the property and casualty exam, you would want to remember, what is the state minimum for car insurance? And you'll see that it's going to be different numbers. Like Texas is like 30, 60, 30. Colorado's like 25, 50, 25. They're all over the place. I don't even have them memorized, but you should have yours memorized. But the point is that they're all different. Every state has their own minimums because each state gets to run their own insurance. So insurance, that's an exam question. Insurance is a state-run program. Insurance is a state-run thing. It is not coming from the president. It's not coming from Congress. It is coming from the state. So it's more like governor instead of president. Now, every state, since insurance is a state-run thing, every state has their own Department of Insurance. And usually they are called Department of Insurance, but in some states they have different names. I think Florida is one of them that has a different name. New York might have a weird name, or they have a couple of different departments, but they're usually called the Department of Insurance, but it may be a little bit different. I'm going to, as I talk about this, I'm going to repeatedly use the phrase Department of Insurance, but just keep in mind your state may have a slightly different name, but that's what I'm referring to. It's whatever the department is that handles insurance in your state, whatever name that is, you should know it for your state, but usually it's Department of Insurance. So every state has a Department of Insurance, and this is like the police and the president of insurance in your state is the Department of Insurance. At every Department of Insurance, there is one person who is in charge of the entire department, and we usually will call this person the director, the commissioner, or the superintendent, with commissioner being the most common name that we'll see. In fact, every state has their own commissioner, and all of them, when they get together, they call themselves the NAIC, the National Association of Insurance Commissioners. So that tends to be the most common names, commissioner. And when they all get together, they call themselves the NAIC. And the NAIC is all the commissioners getting together, and they get together and talk to each other to try to make things easier among the states. You know, there's 50 different states, which means 50 different sets of rules. And when an insurance company comes in to sell across all 50 states, it can get a little convoluted and complicated. So the NAIC tries to do things like, states will try to do things similar to each other so that it's not drastically wild and different. And that's part of like what the NAIC does. You will not really be tested on the NAIC directly, but you will definitely see it in your text and see it as usually an answer choice on your exam. In fact, a lot of the times when they ask you a question related to state law or insurance regulation, they will ask, who do you have to report to? Or who is in charge of this? Or something like that. And NAIC is always tends to be an answer choice there, but it's not what you want to choose, because the NAIC is all the commissioners together, not just your state commissioner. So the answer to questions like that is usually going to be the director or the commissioner, not the NAIC. So you're likely to see NAIC as a answer choice or referred to in questions, but they don't really ask too much about it. But just so you know, it's all the commissioners coming together from all 50 states. Okay, so again, insurance is a state-run program. There is a Department of Insurance in every state, and then there is one person who is in charge of that department, and they are known as the commissioner or the director, and in Ohio, the superintendent. And I think Florida has another weird name for them too. Now, what we want to know about the commissioner is, again, every state is a little bit different. Some states, they elect the commissioner. You have to actually vote for the commissioner of insurance. Some states say that the governor will appoint the commissioner. And if the governor appoints the commissioner, then usually the commissioner will be the commissioner for as long as the governor is a governor. Like basically he picks his team, but when he's done being governor, then the new guy comes in and he'll pick his own new commissioner. Could be the same guy, but it follows the governor. So if your text refers to the commissioner as being elected by the governor and how long he serves a term, those are good things to pay attention to. And another good thing, and this is not true in every state. So this is going to be a little bit of a weird video here because I'm referring to generals and things that are common among all states, but every state is a little bit different. So I may refer to things that are not in your text at all. So I will try to say, if your text refers to this, it's important. But if you don't see it in your text, you don't even, like, it means nothing to you. So I will be mentioning things that may pop up in your state, but not everything I say is going to apply to you because it is so state specific, which is why this class in general is very generic to some extent, but it will give you a really good understanding of the Department of Insurance and also highlight the super important things to know. So with that being said, again, your commissioner is either elected or appointed by the governor. Make sure you know that. If they are elected, know for how long they are elected. And then some states even say that the commissioner has to pay a bond. And a bond is a promise. So when you get a bond, you're basically promising that you will do something or fulfill something. And if you don't, then the bond will pay out to whoever you made this promise to. So if your text refers to a commissioner or a director or superintendent having to pay a bond, do pay attention to that and how much the bond is. That's pretty rare, but there's at least a handful of states that will go over that. The rest don't really. So we have a director commissioner who is in charge of the Department of Insurance in your state, and insurance is a state-run program. The commissioner is either elected or appointed by the governor, usually for the same term as the governor. And what is his job? What is his job at the Department of Insurance? He has a lot of jobs. And the main one, though, is making sure that insurance company, and actually, I'm sorry, let me back up. The main job of the commissioner is to protect the public. That itself can be a test question. The purpose of the Department of Insurance, the main reason for the Department of Insurance, however they might word it, the reason that we have the Department of Insurance is to protect the public. It's not about protecting insurance companies or protecting insurance agents. It's about protecting the public from insurance companies, protecting the public from bad insurance agents. So he's not trying to protect insurance companies. He's trying to protect people from insurance companies. So how does he protect people from insurance companies? Well, he does this by making sure the first and most important thing is making sure that they have enough money. So if insurance companies are saying, if your house burns down, we'll rebuild it. If your spouse dies, we'll pay you a life insurance. They've got to have a lot of money on hand to be able to pay all of our claims. So the commissioner's job is to make sure that they have enough money to be able to pay their claims, that they haven't, that they're, and that also that they're managing their money really well. So insurance companies invest a lot of money. In fact, they take the premium that we pay and they're investing that money and they're growing a lot of money on top of that money. State Farm, in fact, never uses insurance premium to pay themselves. Like commission, yes, but like in terms of the buildings that State Farm owns, the call centers that they own, the salary that they pay to their CEO is all interest earned off of the premium. So there's lots of money to be made off of the premium money, and a mutual company like that, they will leave the premium money available to actual claims, and then they invest all the rest of that money to pay the things that they want. Like it's crazy. Like none of the marketing that State Farm does is coming from claim money, coming from premium money. It's all coming off of the interest. So anyway, the commissioner is checking to see, he needs to know that insurance companies have enough money to be able to pay their claims, that they're managing their investments well, that they're not, cheating or committing fraud or anything like that. Now, the word that we use to describe the Department of Insurance making sure that they have enough money is solvent. The job of the commissioner is to make sure that insurance companies are solvent. S-O-L-V-E-N-T, solvent. Solvent means they have money. Solvent means that they're handling their investments well. So the job of the director, the job of the commissioner is to make sure that insurance companies are solvent and they have enough money. And that's part of protecting the public. That if we have insurance companies that we're going to allow to sell here in this state, we're going to make sure that they have enough money to pay their claims and that they're not going to, hurt the public. It would hurt the public if an insurance company collected premium but never paid the claims on it. So he's making sure that they have enough money to pay their claims and that they're not just collecting premium from us and, committing fraud against us. Now, how does he make sure that they're solvent? How does he know that they have enough money? He knows this because he does what is called examinations. And this is one of the most important things about the director or the commissioner is examinations. Examinations are when the commissioner is able to send in a bunch of file clerks and they go into the insurance company and they go through all of their files and all of their records to confirm that they are doing the right thing, that they're not cheating anybody, that the policies they're selling are valid, that the claims they're paying are good, that they're not, cheating anyone or committing fraud. So every so often, the commissioner must go into the insurance company and review all of their records to confirm that they're on the up and up, that they have enough money, and that they're not committing fraud or cheating anyone. Now, the majority of states, I think 99% of them, are that the commissioner does these examinations once every 5 years. And that's the answer in most states. But I am going to say throughout this whole video, double check your numbers for your state. There are some states that are 3 years, but I can't remember which ones, but most are 5. So every 5 years, the commissioner, and again, check your state, the commissioner is coming into the insurance company with all of his little flyer clerks. They go through the files, they go through the records to make sure that insurance companies are solvent and then have enough money. And all of this is called an examination. Now, while he does it every 5 years in most states, he also is allowed to do it anytime he thinks he needs to. So if he's working, if he just maybe he just finished an examination and everything came out fine, but then like a year later, people keep saying, oh, this insurance company is fraudulent, all these things, he could go back in and do an examination as often as necessary. So while he does do it at least once every 5 years in most states, he can do it anytime it's deemed necessary. And that's the wording that you'll probably see is deemed necessary, meaning we believe it's important, he needs to go do this. So if it's deemed necessary, that means that he's allowed to go in at any point and examine the records. So he usually does it once every 5 years, but he can go in at any time he needs to, or that he believes there's a reason to, and he can do this examination. So one, you want to know that it's one of his biggest jobs is to do these examinations. And the purpose of the examinations is to protect the public, to make sure that insurance companies are solvent. Now, if he finds out that they are insolvent, he can actually take over the company, although they don't get too much into those details. You just want to know that insolvent means that a company does not have enough money. Some states will get into a strict definition about solvent. They'll say that solvent means you're unable to pay your debts over a period of 3 years or something like that. If they do have a definition for insolvent with a number like that, then do memorize that, but not most states don't have that. In most states, you just need to know solvent means that the insurance has enough money, that the job of the commissioner is to make sure that they stay solvent, and that insolvent means that they don't have enough money to be able to pay their claims and whatnot. Now, when the commissioner director comes in to do these examinations, there's one big point that you need to know and memorize is that the insurer is the one who has to pay for the examinations. So when the director, the commissioner comes into the insurance office with all his little file clerks, it's the insurer who's going to be paying the file clerks to do all that work. So the insurance company is the one who pays to be examined. The cost of the examinations is paid for by the insurance company that is being examined. To me, that didn't seem fair. It's like, well, he's coming in every 5 years to go through, like, shouldn't he have to do that? But when you think about, like, when you go to the doctor, you go to the doctor to make sure you're okay, to make sure that everything's fine. You have to pay the doctor to examine you. So same thing with the insurance company. They are paying the commissioner to come in and examine their records, examine everything about what they're doing. So the cost of the exam is paid for by the insurer. Some states will go into detail about what that cost is. Like some states will say it's 1% of all their annual premium. If your state does say something like that, then do try to memorize it. But most states will not talk about what the actual cost is, just that the insurer is the one who has to pay the cost. Okay, so again, we have our commissioner, our director, who's in charge of the Department of Insurance. His job is to protect the public, to keep us safe from bad insurance companies. He monitors insurance companies by doing examinations, make sure that, goes through all of their records, make sure they're not cheating on, committing fraud. He usually has to do this at least once every 5 years in most states, but he can do it whenever it is deemed necessary. And the cost of these exams is paid for by the insurance company themselves. They are the ones who have to pay him to come in and examine all of the records. Now, the next job of the commissioner in terms of keeping us safe is he wants to make sure that whoever is hired as an insurance agent is, again, is educated enough to be able to help people and not hurt people. So insurance is literally is part of the financial industry. We are protecting people's assets. If you own a home, that is an asset. And if it burns down, you lose that asset. So in the insurance company is to protect assets. You're in the financial service industry. My title when I worked for a pre-licensing company, my title was financial services instructor. I'm like, I don't know anything about finances. I know about insurance, but insurance is part of the financial sector. So we are, and that kind of goes to being a fiduciary. We are a person of trust. We are being trusted with people's money. We are being trusted with people's information. And as a fiduciary, we need to be, trusted with money. And the biggest thing, like when the insurance company pays us money, or when customers pay us their premium, our biggest job as a fiduciary is to submit that premium to the insurer. And that could be a testable point from this chapter. Usually fiduciary is either in the state law chapter or the general insurance chapter, but either way, as a fiduciary, you are known as a person of trust, and your biggest job as an insurance agent and a fiduciary is to collect the premium from the customer and to give it to the insurer. And you're not allowed to mix your money together. So when you collect premium money from a customer, you're not supposed to mix that money with your own money. You need to keep it separate from your monies. Now back to the commissioner, when we want to be insurance agents, what does the commissioner make us do? This exam. The purpose of you taking and passing this exam is to confirm that you are knowledgeable enough on insurance so that you won't hurt anybody. Now, by no means do I think pre-licensing and taking and passing this exam means that you actually know what you're doing, but it's supposed to give you a baseline knowledge of, insurance and how it works, so that when you do sell insurance, you're not hurting anybody. So that's when they might say, why does the director make you take the test? To protect the public. Why do you have to, pass the test? To protect the public. Why do anything that the commissioner or director is making you do is all about protecting the public. So passing this exam is a way of protecting the public by making sure that you are knowledgeable enough about insurance so that you won't hurt anybody when you are selling insurance. So in terms of getting a license, not only do you have to take and pass this test, but there are a few things that you need to know about getting a license. One, you've got to be 18. You got to pay the fee. You got to pass the test. Be 18, pay the fee, pass the test. Now, your state exam content may have more than 3 reasons, but those are the 3 main ones that they talk about. You need to be 18, pay the fee, pass the test. What you don't need, which tends to be an answer, and what I mean by that is a lot of times you'll get a question that say, all of the following are needed to become an insurance agent except. So all of the following are needed to become an insurance agent except. What that question is saying is that you're going to read a list of 4 choices. 3 of them you need to become an agent. Be 18, pay the fee, pass the test. What you don't need is a college degree or a high school diploma, not required to get a license. Now, the company you may work for may require a high school diploma, but to get an insurance license itself does not require a high school diploma nor a college degree. So you just need to be 18, pay the fee, pass the test, and you're able to get an insurance license. And another one they throw in there sometimes is that you have to be of good character. And what they mean by that is that you just can't have like a big old criminal record. They don't like criminal records, generally speaking, at the Department of Insurance, but it's not to say that if you have a criminal record, you're not allowed to sell. It depends on the crime, but usually any crimes involving money or dishonesty, or fraud, they're not going to touch you. They're not going to let you be an insurance agent. But if you have a crime like petty theft from years ago, they might be okay. Not, well, maybe not, I don't know, shoplifting, something like that. Not all crimes will they turn you away from, but the bit, like things about money and committing fraud and lying, those things may be reasons why they turn you down. Okay, so again, the commissioner, his job is to protect the public. He's going to make you go through an exam process to make sure that you are knowledgeable enough to be able to pass the exam. Now, in some states, there is what is called a pre-licensing requirement. So most of you probably have like an online course that you have purchased to learn this material, and it comes with like a practice exam. Those are available in every state. But there are some states that make you take that course and that require you to get a certificate that verifies that you did in fact take that exam. So for instance, in North Carolina, where Rhonda's from, she has to have 20 hours in her course and pass every quiz with the 70% and pass or simulate at a 70 in order to get a certificate that will allow her to take the state exam. Not every state has that, and every state's rules are different. Like in Illinois, you're required to spend 7.5 hours in a live classroom in order to get your certificate. And North Carolina has the read it for 20 hours. And a lot of states may say you have this many hours you need to do, or your course is good for this. If your state has a pre-licensing requirement, if in the text that you are reading for state law or insurance regulation says you must complete 20 hours of pre-licensing education in order to get your certificate, in order to take the test, memorize whatever they say. So like in Rhonda's case in North Carolina, she's going to remember I need 20 hours for each line of authority. And I have to, well, they usually don't ask about passing the exam. They just are like getting a 70% on your quizzes, but they usually will test about the hours. So if your text in your course says anything about pre-licensing hours and the hours that you have to complete, do remember whatever that number is. I would say only about 20% of the states have that. So don't assume it's true for you. You got to check your state text and see if it's in there. And if it's in there, do remember pre-licensing. And if it's not, don't worry about it. So you do your pre-licensing, you take your state approved online course, you take and pass your test, and then you get your license. Now you need to know how long that license is good for. So your license could be good for 2 years, 3 years, 4 years, 6 years. Every state is different. Most states are 2 years. And if it is 2 years, the way to remember that, 2 years. And so most states say your license is good for 2 years. And at the end of the 2 years, you can renew it and keep it going for another 2 years. In order to do that, though, you have to take continuing education, which is very similar to your pre-licensing class, where you read the text online, you take some quizzes, you take a test, you pass the test, you're good. That's what continuing education is. You log into a system like Excel, like ExamFX, like Kaplan, you read some information, you take a test, and you're basically just confirming that you're staying knowledgeable about insurance. So that's what continuing education is. It's a way of staying knowledgeable about insurance to, again, make sure that you are educated enough to not hurt the public. So they want to keep you staying educated by having you do the continuing education. So one, you need to know how long is my license good for? And it's during that time that you need to do your CE hours. So if my license is good for 2 years, before the 2 years is up, I need to have taken my continuing education, however long that would be. Some states are like, you need 24 hours of continuing education. Some say you need 36 hours. Some say 12 hours. Every state's a little bit different, but I would say a really big chunk of states say that your license is good for 2 years and you need 24 hours of continuing education. So if that is you, if your state is 2 years and 24 hours of continuing education, what is 2 years in months? 24 months, and you need 24 hours. So if you have a 2-year 24 CE, you can go, my license is good for 24 months. I need 24 hours of continuing education. For each month that I have a license, I need an hour of continuing education. If it's 2 years and 24 hours, but your numbers may be different. Another thing about the continuing education is that in most states, I would say probably 90% of them, they say that you need at least 3 hours in ethics, specifically ethics. And ethics is like doing the correct thing, the moral thing, the right thing. And that insurance, you got to be ethical, that you can't, be committing fraud and cheating people. You need to be an ethical person, so they want you to take an ethics class. Now, in your pre-licensing, ethics is already built in. In fact, the insurance regulation chapter is generally loaded with ethics. So, but when you're continuing education, you need to specifically take an ethics class, and it's usually 3 hours in most states. Now, those 3 hours are not in addition to like the 24. So if we are in a state that says you need 24 hours of CE and 3 hours of ethics, it's not 24 plus 3, it's 24, and you take 3 of those hours need to be on ethics. So when they say, if they say you have an ethics requirement, however many hours it is, those are part of the total hours. It's not in addition to, okay? Now, with CE, some states allow you to carry hours over. So what I mean by that is if they say that you need 24 hours of continuing education every licensing period, and you happen to take a class offered by one of your favorite insurance agents or whatever, and it ends up giving you 30 credits, you only need 24, but you just earned 30. Some states have a carryover provision that will allow you, you only need 24, but you took 30. They will allow you to take 6 of those hours and move it over to the next licensing period. That would be a carryover provision. Some states have it, some don't. Some states say you're allowed to carry 6 hours over. Some say you're allowed to carry 12 over. Some say you're allowed to carry unlimited number over. Whatever it is for your state, know that. If they don't mention anything related to a carryover provision, then don't worry about it. But if they do mention that you can take hours from one licensing period for continuing education and move them to the next licensing period, you need to remember how many. How many hours am I allowed to carry over into the next licensing period? And that is definitely a number to memorize. Okay, so again, Department of Insurance, his job is to protect the public. He does this by doing examinations to make sure that insurance companies are solvent, that they have enough money. He does these examinations usually once every 5 years, but he can do them as often as necessary. And he's making sure that they have enough money to be able to pay our claims, that they are solvent. If they don't have enough money, they are known as insolvent. And the examinations that he does, the cost of them are paid for by the insurance company that is being examined. Then so that's his focus on insurance companies. Then his focus on insurance agents is that they take and pass this test so that they're knowledgeable enough to be able to sell insurance. And then also that we are, of good people, of good character, that we're not cheating anybody. And he also wants us to stay educated. So we have to take continuing education, where however long our licensing period is for, we have to take a certain number of hours to show that we are educated enough to continue to sell insurance. Now, there's usually rules like what happens if you don't do your CE. So you have 2 years to get your CE done and you don't do it and the 2 years are up. And again, that you got to check your state numbers if it's 2 years or not. Most states are 2, but some are 3, some are 4. So you need to know what it is for your state. But during that period, what happens if you don't do your CE? Your license will end up being suspended or revoked until you get your CE hours in. Now, some states will allow like a little bit of a wiggle room where they say, okay, you did not do your CE by the time you're supposed to, your license is now suspended. You have 1 year to get your CE done and submit it to us, or your license will be totally gone and you will have to even take the test again. So if you want to avoid taking this exam again, you got to keep your CE going and make sure that you always do your CE. Otherwise, if you lose your license and you lose it long enough, they will fully take it away and you will have to go through this process all over again. Now, most states are a year that if I fail to do my CE and my license is suspended, I would usually have 1 year of time to do my CE, and I probably have to pay a late fee as well so that I can get my license back. There are some states that are different than a year, like Texas has 3 tiers. they'll be like, if you're up to 60 days late, you pay this. If you're 120 days late, you pay this. And if you're over a year late, you pay this. So if your state has rules about that, I'm pretty sure Texas is like the only one that really gets into it. Most states say you have 1 year to get your CE hours done to reinstate your license, and that you're probably going to have to pay an extra fee or an extra fine for being late. Okay. So he monitors you as an insurance agent, making you take and pass this exam so that you're knowledgeable enough, and that you, in order to keep your license, you are doing continuing education. Make sure you memorize all those numbers. And then to get a license, you have to be 18, pay the fee, pass the test. You don't need a college degree, and you don't need a high school diploma. Okay. Now, so let's go ahead and make our little chart for all the things that we just talked about. And what I would recommend is that you, I'm gonna, like I said, I'm gonna make this chart, and then you're gonna want to get it. I'm gonna give you a picture of the chart, and then you want to, apparently not though, because it's not letting me get in here. I clearly have internet. I'm on Zoom. I have to have internet, but it's giving me a struggle with this whiteboard. So I would recommend that you make this chart, draw it with me, and then you'll need to go to your text to read it, to fill it in. And you'll see what I mean here. Because every state has different numbers. Okay, so this is our state law chart to memorize. State law chart to memorize. So the first thing we want to know is about the commissioner. Sometimes called the director. Either one, commissioner / director. We want to know, if they are elected or appointed. And then how long is the term? How long is the term? So then when you come in here, so this is a chart. So actually you would want to like leave a little space here. So these are the questions that you're filling out. No, yeah, there we go. So you would write this here. It's usually 4 years, but again, double check your state. And then are they elected or appointed? So you would just either choose elected or appointed, or you could just write that in there. But that's what we want to know about the commissioner or the director is, are they elected or appointed, and how long is their term? Okay. Then his biggest job, or his biggest job, and referring to the commissioner or the director, is to protect the public. Protect the public. Okay, so the commissioner's biggest job is to protect the public. He protects the public by doing examinations. And we want to put how many years? It's usually 5 years. So you're going to be making your own chart where you're going to put in examinations, and you're answering how many years, and it's probably 5, but you need to double check your state text to confirm that it's 5 years. And then the purpose of exams So in the same way that protecting the public, he does examinations to do that. Examinations are to make sure that insurance companies are solvent. And solvent means that they have money. They have money. Okay. So the commissioner or the director is in charge of the Department of Insurance. They are either elected or appointed. How long is their term? Their biggest job is to protect the public. They protect the public by doing examinations. You need to know how often are they doing examinations, and that the reason for the examinations and how he protects the public is by making sure they are solvent, which means they have money. Okay, so they are solvent and they have money. Then we want to get into licensing. Licensing, so becoming an agent. To become an agent, that's what licensing is. Licensing is how do we become an agent. And the numbers that we want to know, hopefully that's big enough, we'll see when I make my chart here. The first thing we want to know is that you have to be 18. You have to pay the fee. Let me do it this way. Be 18, pay the fee. So you have to be 18, you have to pay the fee, you have to pass the test. Be 18, pay the fee, pass the test. And what you don't need, and the reason I put it on the chart is because it's usually the correct answer in an accept question, is a degree or diploma. You don't need a degree or a diploma. Okay. So you need to be 18, pay the fee, pass the test to become an insurance agent. And then you need to know pre-licensing. Pre-licensing is, again, sometimes they'll say, you know, you need, usually this is going to be like hours. So do you need 20 hours, 7.5 hours in Illinois? They may or may not have pre-licensing. If they do, you do want to know the hours. Then you want to know, how long is my license good for? How long is my license good for? Okay, you need to write that down. It's usually 2 years. And another thing with that is, how long is my license good for? A lot of times your license will follow your birthday, your birth month, actually. Birth month. What I mean by that is, let's say you pass your test, you get licensed today. Most of us would think, okay, well, if my license is good for 2 years, it'll be good for 2 years from today. But they don't care about the date you actually get your license. They care, they know that you're not likely to remember the day you got your license. It's not an important date. If there's any date that you remember, for most people, it's the day that you pass the exam, because that's, you know, such a beast to have to do. So with your license, in order to keep track and to make it easy for everybody, they base your license on your birth month. So it's like 2 years, every birthday is and it's usually 2 years, like I said. So they usually will say every other birthday, or they'll say if you have an odd number birthday, your license renews every odd year. So like my birthday is 87. That's an odd number. So my license renews every 2 years on an odd numbered year. So my license will renew every time there's a 1, a 3, a 5, a 7, a 9. That's when my license renews, is the following my birth month. So if your text goes into detail about birth month, pay attention. If not a big deal, but I mean, they will always say, and it's key thing, it's not birthday, it's birth month. So what I mean by that is, my birthday is the 3rd. my CE is due, and so it's August 3rd. My CE is not due on my birthday. I have the whole month of my birthday to make sure I have submitted all my CE hours. Now you can do them before. You can literally get your license today, do your CE hours tomorrow, and submit them. You could have them done. You are allowed to get them done anytime during the 2-year period. You don't need to wait till the very end. There are people who wait to the very end, and I've seen them get very angry and upset because, like the company I worked for, we had to tell the state that the people did their CE. We have to submit it electronically that they completed their hours, and that takes time. And some people will get very upset because they're like, my license is going to expire and you guys didn't submit it on time. I'm like, you just did it. You got to give us time. Like, you're the one who waited last minute. So don't wait last minute, especially when it's your birth month. I don't do much on my birth month. I take that month off. So I'm not doing nothing on my birth month. So I would rather get my CE hours done before your birthday, but you at least need to know that's the month you've got. That's when you got to have them turned in by. And if they're not turned in by that time, then your license can be suspended. So one, you need to know pre-licensing hours. You know, how long is my license good for? Then we need to do how many hours of CE? How many hours of CE? And you got to, ask that. You need to know that question. Then, any ethics requirements. How many hours do you need for that? So pre-licensing hours, how long is my license good for? How many hours of continuing education? Are there any ethics? And then is there a carryover provision? Basically, are you allowed to carry those hours over or not? And then you need to know how many. How many of those hours can you carry over? Because you're not necessarily allowed to carry them all over. Okay. So licensing to become an agent, you need to know if there's any pre-licensing requirements. How long is my license good for? Usually it's going to follow your birth month. How many hours of continuing education do I need during that time? Are there any ethics requirements? And is there a carryover provision? Like if I only need 24 hours, but I got 30, can I roll those 6 hours over? Yes or no? And how many hours? Because some states will have how many hours. Now, this little thing is unique for certificate exam states. And what I mean by that is states that require you to get a certificate. North Carolina requires you to get a certificate. If you have a state that requires certificate, there's usually a limit to how long it's good for. How long is it good for? What I mean by that is, like in Ohio, you have to, and we got to say, not most states will have that. But if they do have it, you need to know it. So like in Ohio, for instance, you have to take it, you have to spend a certain amount of hours, you have to take and pass your exam, your practice exam. Then they give you a little piece of paper called a certificate that allows you to take the state exam. In Ohio, that piece of paper allows you to take the state exam for like up to 180 days. And if you don't pass the state exam within that 180-day window, you got to take the course again and get a brand new certificate if you don't pass in that 180-day window. Wisconsin, I think, has something similar. So they have rules. If your state has a certificate, they likely have rules about it, and you need to know what the rules are. How long is that license good for? How long do you have to pass your exam? Because it can eventually like expire. And then I believe Wisconsin also like has a rule about once you pass your exam, you have a certain amount of time to file it to get your license. Like your past exam only works for 1 year, and you have to get your license within that 1 year, or you default and you lose it. So not most states, but if you have certificate, find out what the rules are and know what those numbers are. Okay. Now, the rest of this chapter for state law, well, I'll leave that on there for right now if you're still copying that down. The rest of this chapter then gets into a lot of things. And it can be, you know, what do I actually need to know? Again, I am pointing out to you the most important things. And if your exam is somewhere in the 15 to 17% for state law. So if you can always look up, there's always an exam breakdown somewhere. You can find out what percentage your state is covering state law, because if it is only like 5, Arizona is like 5%. You don't need to know this chapter very well to be able to pass. But most states, again, are somewhere around 15 to 20%. If your state is around 15%, 15 to 20%, what I am teaching you here is more than adequate to be able to pass. And we have a few more things we're going to talk about. If your state is 30%, which is true in Washington and Minnesota and Virginia, Tennessee, I think is pretty high too. If your state is 30% or more, or very close to 30%, you will need to spend extra time in that chapter going over a lot of their other numbers, any fees, any fines, court dates. This chapter has a ton of court dates, because again, this chapter is about you as an insurance agent. And if you mess up or you break the law or something, they're going to take you to court and take away your license potentially. Anything related to court dates are good to memorize, but you're going to see so many numbers when it comes to court date that it could be like a little bit confusing. So one of the things that I would recommend is when you're reading the text. So let's say, you know, you're reading the text and it's about hearings. So like the title will be hearings, and it's going to be blah, 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 10 days, blah, 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 15 days, blah, 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 30 days. Like they're going to have text, and they're going to have a bunch of different like numbers in there for all the things that can happen. Now, this is just for example. But what you want to do is if you do struggle to commit numbers to memory, and not even just commit numbers to memory, but the fact that there's so much that you have to memorize, one of the ways to narrow it down and to give you the best chance of getting the answer right without trying to overwhelm yourself and study and memorize too much is to say, okay, well, hearings, when I'm reading this hearings, what I notice is I see 10 days, 10 days, 10 days. I'm just going to go in my head, 10 days hearings, 10 days hearings, 10 days hearings, 10 days. And what you're doing here is you're picking the most common number, committing that one to memory, and you're much more likely to get the answer right than to try and remember every single thing. So if you have limited brain space to be able to remember these numbers, or numbers are tricky for you, pick the number that you see the most and just memorize that number in relation to the topic. So you might have like another topic that's like fees or fines. Whatever number you see the most, you know, pick that number as the number you're going to remember for fines. So they say like, you know, this thing is a $500 fine. This thing is $1,000 fine. This thing is a $500 fine. This is a $2,000. This is a $5,000. What number do you see the most? Commit that number to memory, because there's only so much space we could have to memorize these things. Okay. So hearings are another big one. I can't make a chart on hearings because it is so drastically different. And what they go into about hearings is so like, if you request the hearing and then the hearing happens, how many days do they have for this? How many days for that? This is what I recommend for hearings, is to find the most common number and pick that. And also 30 is a fantastic number. 30, if you don't know, choose 30. 30 is definitely by far the most common number for even like, how many days do you have to submit a claim? How many days do they have to pay you? How many days do you have open peril coverage when you have a claim? 30 days, 30 days, 30 days, 30 days. 30 days is always a good number if you don't know. So by default, choose 30. And if you can, when it comes to the topics that you have, when you're reading the text and you get to a topic like hearings, find the number that you see the most, commit that number to memory for hearings, and you're likely to be okay. Okay, now the other things that we need to know from this chapter, there's two other main things. I'm going to get into the guarantee association first, and then we're going to talk about unfair trade practices. So this is the state law chart to memorize the numbers that you need to go hunting for. So this is a chart that shows you which numbers you need to go hunting for. Gosh, my whiteboard. I'm going to stop share for a minute. Sometimes sharing the screen too long gives it exam problems. Oh, and I see something in the chat box. Oh, okay. Lizbel cannot wait for that moment. That moment you get you pass your exam. Woo! Yes. And for that moment, it's going to be happening on Wednesday. Okay. All right, so let's try this again. Okay, so this is your chart to memorize for state law. These are the numbers. Again, you need to go to your state exam and fill out the numbers for you. Okay, all right. Now, within this chapter, sometimes this concept is brought up in other sections of the book. It could be in the insurance regulations chapter. I'm sorry, could be in general insurance chapter as well. But a lot of the times it shows up in the state law chapter. So what is the guarantee association? Now, this kind of brings up a couple of points for us. Well, okay, there's kind of two different things. I don't want to write that under there. Let me write that. Let me do, it made me prompt two different things here real quick. So first, we're going to talk about certificate of authority. Certificate of authority. And again, this could be general or the state law chapter, but a lot of times it's in both, actually. What is a certificate of authority? When an insurance company wants to sell in a state, they have to go to the Department of Insurance in that state and ask, can I sell insurance here? And if the Department of Insurance says yes, they will give the company a certificate of authority. So they will say, yes, you are allowed to sell. Here is a certificate of authority so that you can sell. What we want to remember about is, and then the certificate of authority makes the insurance company admitted or authorized. So if they say, there's a couple of questions they can ask you on the exam, and that's what I want to cover right here. The first question is, before an insurance company, before an insurer can sell in the state, they need a certificate of authority. Before an insurer can sell in the state, they need a certificate of authority. Then they're gonna they want you to know that a certificate of authority makes a company admitted, admitted, add 1D. Admitted and authorized. Never certified. So a certificate of authority doesn't make you certified. Never pick the word certified. It is never an answer ever for anything. Nothing is certified. They'll never use certified, and certified will never be an answer, I promise. But they like to throw it in there when they ask about a certificate of authority because certificate makes us think certified. But don't, delete it from your brain, never pick it. So one question will be, what does an insurance company need before they're allowed to sell? A certificate of authority. That's one question. Then another question will be, if an insurance company has a certificate of authority, what does that mean? It means that they are admitted. They are admitted to be allowed to sell. Or the answer may be, if an insurance company has a certificate, what does that mean? It means they are authorized. They will use admitted and authorized interchangeably. And then Sometimes they'll do something a little extra tricky. They will say an insurance company is admitted. What does that mean? An insurance company that's admitted is authorized. Or they'll say, what is an insurance company? What does it mean if an insurance company is authorized? Well, it means they're admitted. Admitted means authorized, authorized means admitted, and admitted and authorized means the insurer has a certificate of exam, a certificate of authority. So before an insurance company is allowed to sell, they need a certificate of authority. The certificate makes them admitted or authorized. Admitted means authorized, authorized means admitted. Okay, a little bit funky, but if I'm admitted, I'm authorized. If I'm authorized, I'm admitted. You're going to be good. Now, there is an exception to that rule. And the exception to getting a certificate of authority is surplus lines. Surplus lines is difficult or hard to place insurance. These are insurance companies that will sell insurance to amusement parks and airports, like very risky things, difficult, hard to insure. That's surplus lines. So you can even write that, hard to insure. Hard to insure. That's surplus lines, is hard to insure. What we want to know is surplus lines does not, they don't need a certificate. So they're actually known as non-admitted, but they're not unauthorized because they are allowed to sell. So surplus lines don't need a certificate. They're known as non-admitted, but they are allowed to sell. So I got a question in the chat box. Would those be for brokers? A broker is, there are surplus lines broker, but a broker doesn't imply surplus lines. A broker, when we're looking, and this is not a huge thing for your exam by any means, but as an insurance agent, you should be aware of this. You're actually either an agent or a broker. An agent works for a company. A broker works for the customer. When you go to an agent, think of like a store. When you go, like the agent works for like State Farm. So when you go to the agent, you are going to buy from that company. It's like going to one place and you can only get from that one place. Now, as an agent, you could work for many companies, but your ultimate goal is for the benefit of the company. A broker is more like going to a shopping mall. And there's like, well, there's this store, and then there's that store, and then there's this store, and then there's this store, and there's that store, and that store. And the customer goes to the broker and they say, I want the cheapest premium. And the broker will say, okay, let me check here. Let me check here. Let me check here. Actually, this one is the best one for you. You should buy that one. And it's not the broker. Again, the broker is trying to do the best thing for the customer, where the agent is doing the best thing for the company. So that's the difference between an agent and a broker. And a broker like really truly works on their own. Now an agent can too. It's kind of weird, but the ultimate thing of an agent is that they work for a company. The broker works for the customer. Now you can be a surplus lines broker, but you can also just be a regular broker. You don't have to be surplus lines to be a broker, but surplus lines agents are known as surplus lines brokers because yeah. Well, they could be agents too, but anyway, so certificate of authority, again, before be an insurer, I meant to put the word before. Before an insurer can sell. Before an insurer can sell in the state, they need a certificate of authority. A certificate of authority makes a company admitted and authorized. Admitted means authorized, authorized means admitted. Surplus lines is the one exception to the certificate of authority. Surplus lines is hard to insure insurance. and you don't need a certificate. If you're surplus lines, you're known as not admitted. Now, every company, so this is bringing us to this next point. Every authorized insurer, which means every company that has a certificate of authority, which means every company that is allowed to sell, every authorized insurer must become a member of the Guarantee Association. I'm going to abbreviate that as GA. You don't want to have to write all that out. So every authorized insurer must become a member of the Guarantee Association. So that's why I jumped in the certificate of authority when I originally wrote Guarantee Association, because I want to say, well, who is part of the Guarantee Association? It is every authorized insurer becomes a member. So the Guarantee Association, when you see the word association, it means membership. An association is a membership. It's a group of people who all become members. Membership implies that you are paying a fee. So if you are a member of something, you have to pay a fee. So what we're saying here is that every authorized insurer, every company that is allowed to sell in the state has to become a member of the Guarantee Association. Now, the Guarantee Association is the main phrase, but they're always going to label it like the North Carolina Guarantee Association, the New York Guarantee Association, the New Mexico Guarantee Association. So when you read your state text, they're usually going to have the name of your state with the Guarantee Association. But everything I'm saying right now is true for all guarantee associations, no matter what state you're in. So every authorized insurer must become a member of the Guarantee Association. And what is the Guarantee Association? It is insurance for insurance. Insurance for insurance. Now, what we mean by that, when an authorized insurer joins the Guarantee Association, and they have to, if they are authorized, it's a condition of being authorized, is that you become a member. Every authorized insurer must be a member. Everyone that's a member is paying a fee. This fee, this money is being saved and collected and stored by the Guarantee Association. And if one of the members, one of the insurers, which every authorized insurer has to be a member, if one of the insurers runs out of money and is unable to pay their claims, they will go to the Guarantee Association and say, hey, I insured too many people. I can't afford all these claims. I need help paying my claims. The Guarantee Association will kick in and pay the claims. That's why it's insurance for insurance. So the Guarantee Association is a state-run thing that is the backup to insurance companies. So if the insurance company is unable to pay their claims, they go to the Guarantee Association. The Guarantee Association will kick in and pay their claims for them. And so it's insurance for insurance. Now, there usually is a limit. It's not always, it's usually a test question on life and health insurance, not so much on property and casualty, but they can't pay every possible claim to every dollar. Like, you know, if they have to have a limit. So they will say, you know, every claim is limited to, and it's usually 300,000 is the number to memorize, sometimes 500,000. So you have to check your state, especially if you're doing the life and health exam. They will want you to know what is the max that a person can get from the Guarantee Association. It's usually 300,000 or 500,000, but not too big of a worry for most people. What you want to remember about the Guarantee Association, definitely for sure, is that every authorized insurer must become a member. As a member, they pay a fee. That money is used to pay claims when one of the members cannot pay their claims. The other big thing to remember about the Guarantee Association is that it is, and I'm going to write it as they will say it so that you can recognize it on the exam. It is an unfair trade practice. It is an unfair trade practice to advertise, or is it they use the word, it is an unfair trade practice to advertise that the insurer is backed by the association. Okay, what am I saying there? Let's say you are working for a brand new insurance company. You just got started and you're selling to all your friends saying, hey, buy insurance from me. And they go, well, you're a brand new company. I'm a little nervous that you won't be able to pay my claims. You don't have any history, so I'm a little nervous. And you say, oh, don't worry about that. We are backed by the Guarantee Association. So if we don't pay your claims, they will. So feel comfortable buying insurance from us. You're not allowed to market that. You're not allowed to advertise that you are backed by the association. First of all of them are. If you're an authorized insurer, all of them are backed by the association. But you're not supposed to use it as a marketing tool. So you're not supposed to, make it a thing. Oh, we're backed by the association. You should buy insurance from us. So it's considered an unfair trade practice to advertise that the insurer is backed by the association. Okay. Yeah. Okay, now we need to talk about unfair trade practices. This is the next major concept that we want to know and memorize. And these are unfair trade practices are things that you as an agent are not allowed to do. One of them being talking about that you're backed by the association, you're not allowed to do that. And then there's a few more that you're not allowed to do. And I'm going to cover the most tested ones, the most commonly asked about ones. Now, your state may or may not have all of these. But again, I'm doing the most common ones that I have seen across most of the states. So when you're reading your state specific text, if I put twisting, if you never read about twisting, you haven't seen twisting anywhere, it wasn't in any of your practice, then you don't need to know it. But if you have seen it brought up, if you have seen it when you read your text, then you do need to know it. So just keep that in mind. I'm teaching generically. You want to confirm in your text if you need to know these things or not. And if you do, if it's easy for you to know and memorize them, by all means, just memorize them. They're not going to hurt you to know it. You're likely to actually see, even if these words, some of them you don't need to know, there's still likely to be an answer choice. And so it's good to know what it is so that you don't pick it. So since they're going to use all kinds of insurance words in there, and whether you're being tested on that word or not, it's likely to be listed as an answer choice. So if you at least know what it is, you can make sure you don't pick it. Because for some weird reason, people do this, is they will read a test question and they'll see A, B, C, D. And then for instance, the NAIC, let's say you didn't go through this class. So you didn't learn that the NAIC is the National Association of Insurance Commissioners. You don't remember ever seeing the NAIC. And now here it is as an answer choice. And we get so caught up into not knowing what it means that we think it has to be the answer. And we're like, I don't know what this means, but it's here as an answer choice, so I'm going to pick it. No, what are you doing? If you don't know it, it's not a choice. Keep in mind, when they have multiple choice questions, they have to have 3 fillers. There can only be one right answer in a multiple choice. 3 of these things have to be made up, have to be something else, are not correct. So it's likely that one of these 3 things will be a phrase or a word that you don't know. Don't think that it's it. Don't think that that's the answer. If you haven't seen it, it's not the answer. But what my point in saying all this is that for all the words that I'm about to teach, they're likely to be seen on your exam, but they may not necessarily be a concept you need to know. So if you do know it, you know not to pick it because it's not going to be the right answer. Hopefully that makes sense. All right, so now we are doing unfair trade practices. Unfair trade practice. These are things Again, an unfair trade practices are things that you as an agent are not allowed to do. Unfair trade practice. Okay. The first thing is misrepresentation. And this would be lying to the customer. You are not allowed to lie to the customer. Okay, so you're not allowed to lie to the customer. Do not lie to them. Do not misrepresent policy benefits. Do not lie to them. So misrepresentation as an unfair trade practice would be lying to the customer. Now, there are a few things that are also lying, and it can get a little funky. Misrepresentation is just a pure lying. But then you have like something called false advertising. That one is lying in advertising. Lying in an advertisement. So I meant to be that yellow. Misrepresentation is lying to the customer. False advertising is lying in an advertisement. Lying in an advertisement. So if they say you lied to the customer, misrepresentation. If they say you lied in an advertisement, false advertising. Okay. And then there's another one that's also lying that is called twisting. Twisting. Now, twisting is a false comparison. A false comparison of two policies, two or more policies at least, whatever. A false comparison of two policies in an attempt to get the customer to cancel their current policy and buy yours instead. Okay, so I'm going to explain this, but this is our definition that we want to write down. Is that twisting is a false comparison of two policies in an attempt to get the customer to cancel their current policy and buy yours instead. So what we're saying here is you go to a customer and let's say you're trying to sell life insurance and they say, well, I already have life insurance. You say, can I see your policy? So they give you a copy of their policy and you say, well, this policy is not so good because it doesn't have this and I have that. And your policy, it's got this, but I have this. If what you're saying is true, great job. If what you're saying is true, it's a great job. But if you're twisting your words, you're twisting their arm to try to get them to buy, that's not okay. You're not allowed to make a false comparison. If you're telling the truth about the two policies, great, awesome. But if you're lying, if you're twisting your words a little bit to make your policy sound better than what it is and their policy sound worse than what it is, no, you're not allowed to twist. So twisting is a form of lying because it is a false comparison of two policies. And usually they'll say it's to the detriment of the insured. It hurts them. It hurts the customer if you lie about the policy they have and have them buy yours instead, especially if the one they buy instead has less coverage. And this could be something that's important to understand, especially if we're talking about life or health, is if I buy, and this is important to know as an insurance, maybe not a testable point, but important to know as an insurance agent. If I buy life insurance, when they ask me questions, they're asking me all about my health and all about the things that are going on with me. And as long as I'm healthy and not, super risky, they'll write me a life insurance policy. Once they write that life insurance policy, anything medically that happens to me is covered, especially if I die from it, for life insurance. But if I were to cancel that life insurance and get a new policy, any medical things that I've experienced in my past could prevent me from getting coverage by this new policy. What your policy has to be in effect before you have medical issues, is what I'm trying to say. And if you have medical issues and then try to buy insurance, they will exclude anything that happened to you before as being a form of coverage. So like if I buy insurance and then I have cancer, the cancer is covered. Twisting is saying, the reason that twisting is such a problem is because if I buy insurance, let me just show you what I mean so you have a physical representation. If I were to buy insurance in, let's say, 2020, and then time goes on, and in between here, I have a heart attack. This policy will cover me if I die from the heart attack, because the heart attack happened after I got my insurance. Twisting is saying that you're going to tell the customer to cancel that insurance and to buy yours instead. So then they do that. This policy is going to exclude heart attacks because they had one in the past. And when we start this policy, they're going to ask that question, what is your major medical issue? They might exclude it. So when you tell the customer to cancel this one and to get yours instead, that can hurt them. They can lose coverage because of pre-existing conditions. So you as an insurance agent need to be super careful when you're asking them to replace their insurance, because they could lose coverage. And that's why twisting is seen as a detriment, not only because you're lying to the customer, but because they could be losing, amounts of coverage depending on what's happened to them medically. Not so big in property and casualty, but definitely big in life and health. Okay. So those, so again, these are all lying. Misrepresentation is lying to the customer, but it's just a pure lie. It could be an oral or a written statement, but it's lying. False advertising is lying in an advertisement. Twisting is a false comparison of two policies in an attempt to get the customer to cancel their current policy and to buy yours instead. You are not allowed to twist. You're not allowed to do any of these. These are all the things you're not allowed to do. The next one is rebating. Now, rebating is the simplest way to say this is bribing the customer to buy your insurance, to buy your policy. Rebating is bribing the customer. You're giving them a bribe. Buy this and I'll do this. If you buy it, I'll let you have this. That's a bribe. So rebating is bribing the customer to buy their policy by offering the company or offering the customer something extra. Okay, you are not allowed to do that. And another thing that they will say this as, offer the customer something extra. Another phrase that they will use for that is illegal inducement. An inducement, I think the most word that we know about inducement is when a woman is pregnant and we induce her. We induce her when she's pregnant. We're trying to make the baby come out faster. So when a woman is pregnant and the baby's not coming out, they will induce the woman, which means they try to make the baby come out faster. And that's so an inducement, an illegal inducement would be rebating. An example of that is buy my insurance policy and I will give you some of my commission check once I get it. Buy my insurance policy and I will give you season tickets to the game. Buy my insurance policy and you can stay at my hunting cabin for the winter. Buy my insurance policy and I will blah, blah, blah. You're not allowed to give something extra to get them to buy it. Now, some things that are okay. So you do want to know that certain things are okay. So a multi-policy discount is okay. A lot of times I've seen on the test like a grand opening. So what we mean by that is if you're an insurance agency and you invite all of your customers to a party, a grand opening, a summer barbecue, you are giving them something, you know, like food. But if it's a party, then that's fine. That they don't see that as a rebate or an inducement. So a multi-policy discount is okay. A grand opening is okay. Trying to think of anything else. But what's not okay is cash or how do they word it? Guaranteed dividends. So a dividend is a guaranteed dividend, or I'm sorry, I don't want to circle all that. A dividend is a return of excess premium. What we mean by that is if an insurance company estimated that they will have like $3 million of claims, so they collect enough premium to have $3 million to be able to pay out claims, but the claims that filed only end up being $2 million, they have an extra $1 million. And if it's a mutual company, they will give that dividend back to the policy owners. Rebating would be guaranteeing them extra or advantages, like, oh, you'll get more dividend than anyone else. You're not allowed to give that away. Now, there are some states. So we have a little exception here. So when it comes to rebating, there is some states actually do allow rebating. I forget which one, but they allow rebating as long as everybody gets a rebate. And it has to be like published and like typed up and like available for everyone to see. I forget which state that is, but some states do allow rebating. Most do not. If they do allow rebating, they have a lot of rules about it. And again, it's only like 1 or 2 states I've ever seen that. But some states will allow a small marketing allowance, promotional allowance. A small market or promotional item. What we mean by that is you may say, if you come to my insurance office and get a quote, I will give you a free water bottle with our insurance agency's name on it. And everybody who comes in for a quote gets a free water bottle. That is okay in some states, and you want to know how much. So if your state says that you are allowed to pay, or that you're allowed to give away a promotional item, they're usually going to say it can be no more than like 25, 50, or 100. The states have various numbers. So if that is in your text, you do want to remember that how much that money is. Make sure that you check your state text and confirm that you know the amount of money. And Lisbeth asked that. So Lisbeth, we would need to double check New York. I think it's 25 in New York, but I'd want to confirm. Okay, so rebating is bribing the customer to get them to buy their policy by offering them something extra. That is known as a legal inducement. You're not allowed to do it. Multi-policy discounts are okay. A grand opening party is okay, but not cash, not guaranteed or advantages in dividends. And some states will allow a small market promotional item for an X amount of dollars. And you want to learn what is that X amount of dollars. Now, a lot of people will confuse rebating with coercion. I'm going to spell coercion. Coercion. Probably spelling that wrong. I don't spell very well, so forgive me for that one. Coercion is where rebating is a bribe, which feels good. Like most people feel good when they're bribed. They're going to get something. Ooh, I like that. You can bribe me all day long. Bribes usually feel good. Coercion is more like a gun to your head. Coercion is like a force, where a rebate is a bribe. Coercion is a force. Buy this insurance or else. That is coercion. So coercion is forcing the customer. Now, forcing the customer is not how they're going to ask it. That's not how it's going to show up. Forcing the customer to buy. That's not really how it shows up on the exam. The way that they talk about it on the exam or within the text, the way that they are going to talk about it on the text is they'll ask you a question like this. They'll say, Rhonda went to the bank to get a loan. As a condition of the loan, the bank told Rhonda that she must get life insurance so that if she dies, the life insurance will pay off the loan. They told Rhonda that she must get life insurance from XYZ agency, or else they would not give her the loan. What is this known as? And the answer would be coercion. Coercion is a bank. So let me back up a little bit. A bank is allowed to require that you get insurance to back any loan that they give you. So if they say, if you want a business loan, a car loan, a home loan, they are absolutely allowed to say, we want insurance on that, so that if you do die, the loan will get paid off. A bank is allowed to do that. What a bank is not allowed to do is tell you which insurance company you have to buy it from. So if Rhonda comes in and says, I want a business loan, they can say, okay, Rhonda, we will give you a business loan, but you need to get life insurance in case you die, it will pay off. If they say, Rhonda, you have to get it from XYZ, or else we won't give you the loan, that is coercion. You're forcing the person to go with a certain insurer. But you're actually allowed to go to any insurance company. So if they say you have to get a insurance policy to get this loan, you're allowed to go anywhere you want to get it. They cannot require which insurer you use. They can require that you get insurance, but they cannot say it has to be this one. So coercion would be forcing the customer to buy. And specifically, we want to remember that a bank is allowed to ask you, or is allowed to require, that's a better word. A bank is allowed to require that you buy insurance to get a loan, but they cannot tell you which company it has to be. Okay, so that's the concept that we want to know for the exam. And I remember taking the Colorado exam, and this showed up like multiple times. A bank is allowed to require that you buy insurance to get a loan, but they cannot tell you which company it has to be. And if they do try to do that, that is what makes it coercion. If they try to tell you which company it has to be, that is what makes it coercion. and they're not allowed to do that. Okay. 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 Oh, the next one we've got is unfair discrimination. Unfair discrimination. And notice how it says unfair discrimination, meaning we are allowed to discriminate. Insurance companies absolutely discriminate all day long. Young, old, healthy, unhealthy, good driver, bad driver. All day long we discriminate. We're just not allowed to do it unfairly. And unfairly would be judging people based on their, so you're not allowed to judge them on race, religion, sexual orientation. So if you're gay or straight, that doesn't make a difference. Gender identity. Insurance companies really do not care what you identify as. Doesn't even, in fact, even, you know, with the whole marriage thing, you have to be married to get insurance. That's not an insurance company's rule. That's like an employer's rule. Insurance companies really don't care. And in fact, they don't care about same sex or not. They could care less. If you're living together, they deem pretty much everybody as like, what is that called? When you're married, but not no, I don't know. But anyway, that's a side tangent anyway. Insurance companies don't really care about that kind of stuff. Race, religion, sexual orientation, gender identity, things like that, you're not allowed to touch. One of the ones that confuses people a lot is marital status. Marital, M-A-T. Marital. I don't know how to spell marital. I feel like I'm going to spell material. Marital? Marital. I have no idea how to spell marital. Married or not. Let's just say married. Marriage. But it is marital status. Oh, thank you, Rhonda. That looks like Marshall to me. M-A-R. M-A-R. Yeah, you guys spelled it right. No, wait. M-A-R-I-T-A-L. That looks right. Oh, I love being a highly paid instructor that cannot spell. It just breaks all the rules. That looks right. Marital status. That's what I had in my head, but it kept looking like material and it just wasn't. I'm like, the brain is not functioning. M-A-R-I-T. Okay, we did it. Okay. What confuses people about marital status is we know that insurance companies will ask us if we're married or not married. And we know that it can impact our, well, most of us know it can impact your premium. Like me being married dropped my insurance rate significantly. So marital status does impact our premium. And they do use it as a factor to determine our rates. What they don't do is they can't deny us if married or unmarried or divorced. Married, unmarried, or divorced. Basically, what I'm saying is they can't use your marital status as a reason to turn you away. They can use it to assess your premium and assess your risk, but they cannot decline you insurance because you're married, unmarried. Oh, you're divorced. We don't like divorced people. Go away. Not allowed to do that. So they're not allowed to discriminate. They're not allowed to deny you coverage because you're married or unmarried. The other one that we want to know with unfair discrimination is same class, same premium. A class, and this is not everyone needs to know this, but a class is also known as a homogeneous, which is basically people with the same risk. So what I mean by that, like if I'm buying, you know, when you buy car insurance or life or health, whatever, you're answering questions of the things they're allowed to ask, right? They're not allowed to ask us everything. They're not allowed to ask us, our gender orientation or our gender identity. They don't ask us that stuff. Of the things they're allowed to ask, there will be people who answer the same way you do. Those people get put into what is called a homogeneous, which is how they do the law of large numbers. So back in like the general insurance chapter, we learn about the law of large numbers, which is how insurance companies make predictions about how many claims we're going to file. When we answer questions on our insurance application, we're going to answer questions the same as someone else. Even if you're 1 in a million, there's 7,000 people just like you. So there's people just like you, people who answer the same way you do, people with the same risk level. I'm in a category of 35-year-old women with, I don't know, 10 years of driving experience, whatever it is. Like they put you in a group of people just like you. So that is your class or your homogeneous. Your class or your homogeneous is people, basically the shortest way to say that is people with the same risk. So all women drivers between the age, 30 to 35 will be in one homogeneous. Okay. Teenagers have their own homogeneous, So what we're saying here is that when all the people, if they're in the same class, they got to pay the same premium, same class, same premium, same class, same premium. Like for instance, if this is my homogeneous, you got all these people in your homogeneous, they all need to be paying the same premium. So they're same premium, same premium, same premium, same premium, same premium. What an insurance company is not allowed to do is say, oh, well, this one's gay, so we're going to charge them extra premium. Or, oh, this one's a different religion, we're going to charge them even more premium. They're not allowed to do that. Same class, same premium, same class, same premium. It is known as unfair. This could be a question. It is known as unfair discrimination if they were to try to charge someone in the same class a different premium. Some of the example questions that I have seen have said there are twin sisters. Everything about them is like the same, except one sister makes a lot more money than the other sister. So the insurance company was like, well, let's charge that sister a higher premium since she can afford it. What is this known as? The answer is unfair discrimination. Because if they're in the same class, they got to pay the same premium. Same class, same premium, same class, same premium. All right. I just want to double check make sure I hit all the big ones. Misrepresentation, false advertising. Oh, one more. There's another one. I knew it. I knew there was something else. The next one is, what was I doing? Oh, I don't know. Defamation. Defamation. The word defamation is to defame. If someone is famous and you defame them, you're taking away their fame or you're talking badly about them. That's what defamation is. Specifically on the insurance exam, it would be talking badly about the financial condition of another company. Defamation is talking badly about the financial condition of another company. So defamation would be like you as an insurance agent talking to a customer, and the customer says, well, I have State Farm. Why should I buy your insurance? Oh, State Farm sucks. You don't ever want to get insurance with State Farm. They never pay their claims. They're horrible about money. They're always losing investment, blah, blah. No, you're not allowed to do that. Do not talk badly about another insurance company. Even if what you're saying you feel is true, just don't talk badly about another insurance company. And defamation they really like to hone in on the financial word. That defamation, because I'll say talking badly about another company, but they really love to hone in on the financial part. It's talking badly about the financials of another company. Okay. Okay. All right. So we have talked about how insurance is a state-run thing, that there is a commissioner or director in charge of insurance in your state. Their main job is to protect the public from bad insurance companies, bad insurance agents. They do this by doing examinations where they go in every so often to review the company's records and make sure that they're doing the right things, that they're not cheating anybody. They usually have to do these exams once every 5 years, but they can do them anytime that they think there's something going on. And part of the examinations is to make sure that they're solvent, that they have enough money. Another way that he protects the public is by managing licensing and making sure that the people who become insurance agents follow the rules. You may have to do pre-licensing where you do education and then you test and then you can get your license. But the main thing about getting a license is that you have to be 18, pay the fee, pass the test, and be of good character. Don't have any crazy criminal records. And then once you get your license, the director will require that every so often you stay educated about insurance and you do what is called continuing education, where you continue to learn about insurance. You have to do so many of those every few years. So you need to know how long your license is good for, how many continuing education hours do you need to keep your license. And then you want to know about the unfair trade practices. Misrepresentation is lying to the customer. False advertising is lying to the customer in advertising. Twisting is a false comparison of two policies to get the insurance company, to get the customer to buy yours instead. You're not allowed to do that. Rebating is a bribing the customer to try to get them to buy insurance by offering them something extra. You're not allowed to do that, although you may be allowed to do a small promotional item. Make sure you know the numbers of that. Coercion is forcing the customer to buy insurance, holding a gun to their head. Usually that's a bank that says, if you want this loan, you have to get this insurance from this company. They're not allowed to say which company. And then defamation is talking badly about the financial condition of another company, and you are not allowed to do that. And unfair discrimination. Do not discriminate against customers based on their religion, gender identity, race, creed, nationality. Blindness is one. You're not allowed to judge someone on being blind. And marital status. And with marital status, they can't deny you marital status. And same class, same premium. One other concept, not a huge one, but definitely shows up, is controlled business. Controlled business. And this one is kind of an interesting idea. And again, every state kind of has their own rules about it. Controlled business, so it's a weird way because you wouldn't say it's, okay, so if I sell myself insurance, I'm allowed to do that. I can sell myself a policy and earn commission on it. I can earn my own commission by selling myself insurance. I can sell my family insurance. I can sell my spouse insurance and earn commission. You are absolutely allowed to do that as an insurance agent, but you're not allowed to make it your main business. If selling to your family and yourself is the main way that you make money from insurance, we call it controlled business. Selling one policy to your family, to yourself, whatever, selling a couple policies is okay, and we don't call it controlled business. We only call it controlled when it is generally more. So controlled business is, here's the best way to say it. Controlled business is when you sell more to family than the public. Most states will say that you have to sell at least 51% to the public And then you can do 49% to your family. They don't always use percentages. So don't memorize these numbers by any means. The main thing is that controlled business is when you sell more to your family than to the public. You're supposed to sell more to the public than you do your own family. But if you do sell more to your own family, they will label it as controlled business and they will take away your license because you're supposed to be selling more to the public than you sell to your family. So this is where we get a little bit weird, is when they say you sold $1,000 premium to your wife and you sold $11,000 to the public. What is this known as? And the answer is it's a legal practice. You're totally fine. You can sell $1,000 premium to your wife and $11,000 to the public because you sold way more to the public than your wife. We don't call that controlled business. We only call it controlled when it's the main thing that you're doing, when it's the majority of what you're doing. So selling to your family is fine. Selling to yourself is fine. It just can't be the majority of what you're doing. You need to sell 1 penny more to the public than you do your family. And some states it's a penny, like they don't say penny, they'll say percent. Some don't even say a percent. They just say you got to sell more to the public than your own family. Some states do allow, again, there's always weird exceptions, and some states do allow controlled business, like there's rules about it, just like there is rebating. Some states do allow rebating. It's just heavily restricted with all the rules. Okay. All right. Any questions about state law or anything that we've talked about thus far before we end our class for today? Okay. All right. I'm going to go ahead and stop the recording.